Pros is brought to you by the Real Money Pros and the sponsors heard within this broadcast. Material presented on this program may not be suitable for you. Consult a registered investment advisor when evaluating any particular investment, security, or investment strategy. The views, opinions, or advice offered by the hosts and guests do not necessarily reflect those of this station. Brian Wiley and Jeremiah Bates are investment advisor representatives with Apollon Wealth Management, an SEC registered investment advisor. The Real Money Pros with Brian Wiley and Jeremiah Bates, the weekend's smartest money show. Investing, taxes, legal topics, insurance, and every other confusing money topic made simple.
Welcome to the Real Money Pros. We are back after about a week-long hiatus. I'm Jeremiah Bates, fiduciary financial advisor, joined with Alexandra Lundgren, my colleague, who is also a fiduciary financial advisor. I'm fortunate enough to have her a couple feet down the hallway from me, so I can pick her brain because she's one of the smartest people that I've ever met, and her depth of knowledge when it comes to Social Security, when it comes to retirement plans, especially if you're self-employed and you're looking at doing maybe these other type of pre-tax accounts that you can take advantage of to lower your taxable income. But you also got to be considerate of your employees. How are you structured? Do you want one business? Do you want multiple business? There's some nuance and some, I would argue, complexities, especially when, like, listen, it's a T-chart, right? Pro-con analysis. When you're self-employed, the tax code opens up to your favor tremendously. But the devil's in the details. You got to make sure that it's executed properly. So we certainly want to cover some planning strategies for you self-employed folks. And even if you're not self-employed, maybe you're seeking to go on a self-employed endeavor and you want to know about these benefit offerings that help you as the owner and you as the employee, or if you have other employees. The beauty of this program, hey, there's lots of financial programs on the radio that you can listen to. So number one, we certainly appreciate you listening to us. But I would say the big differentiator here is that, number one, we're not trying to sell you anything. We are here to give you advice. Period. End of story. We are a sponsor-driven program. So if there is one thing that we ask of you is go to our website, therealmoneypros.com. Find our sponsors, whether it's Ataraxis PEO. Again, we're going to be talking to you self-employed individuals for a little bit. Ataraxis PEO is a professional employer organization. They can help you handle payroll, benefit offerings. Listen, if you're self-employed, you probably want to focus on your actual business endeavors, not the time-consuming headaches of handling HR. That's where Ataraxis PEO can help. Apollon Wealth Management, if you're an advisor looking to coordinate with a great team that gives you great support, Apollon Wealth Management, or if you're an investor and you're looking for a fiduciary advisor, we have an awesome network of advisors across the country that can help you. Again, that is therealmoneypros.com. We actually just had a pretty big update, a big upgrade to our website, which we're very excited about. Take our assessment, take our questionnaire in regards to the BetterBuckets System. We're going to talk about buckets, time-based investing based on a strategy that you can effectively solve for. I met with a client earlier this week where he worked for the federal government, recently retired. In his TSP, which is the equivalent of a 401k, I guess you could say, for you federally employed individuals, where you're deferring money into a retirement plan. There's various investment options inside of the thrift savings plan, and one of those is the G Fund. And the G Fund just basically means you're in cash alternatives, extremely conservative. So upon his retirement, he moved everything to the G Fund because he didn't know what the next step forward was. He's got a HELOC. He's got mortgage. They have a child who's come under illness that needs some support. One of the spouses is still working, and they're trying to figure out what their cash flow is and how much they can effectively draw out of that to pay off debt, but also be tax conscious. This is the purpose of the BetterBuckets System. It effectively shows you how you can solve and structure your money from an investment standpoint to handle all of that, whether it's paying down debt as you enter in retirement, making sure that you can sustain your quality of life without running out of money, getting that proper balance between where do I need to be conservative, where I can still be growth oriented, and where do you need to supplement with income producing investments, whether that's bonds, it's dividend paying stocks, it's enhanced equity funds that are giving enhanced yields through options writing. Maybe it's structured notes. The list goes on. But again, you can find out more at therealmoneypros.com. And of course, number 2, the big differentiator I would say is that we are live. Phone lines are open. Call us if you have something a question, tax related, estate planning related, investment related, retirement planning related. You name it, send it our way. Try to stump us. I dare you. Phone lines are open 979-59-MONEY. That is 979-596-6639. Okay, my long-winded introduction. If this is the first time tuning in, you now get an idea of how we operate. Alex, let's talk about you're self-employed.
Okay.
I work with a number of business owners that it's just them as an individual. No employees, meaning they have an LLC that's filing as a sole proprietorship, or they have an LLC that's filing as an S Corp. And I also have clients that are corporations and they employ a number of employees, 10, 15, 20, maybe even 30, right? The list goes on. So when you are self-employed, like I mentioned, the tax code works in your favor. There's a lot of things that you can do to offset your taxable income. Obviously, legitimate business write-offs. There's a cost of doing business. Make sure you're taking advantage of those. One question that gets brought up and say, well, can I write this off? I'm like, I don't know. Is it number one?
I'm not a CPA.
Yeah, talk to your CPA, talk to your tax counsel. But I think a good rule of thumb to stick by is, hey, if this is ever questioned, if you're ever audited and the IRS is sitting in front of you and saying, hey, you put this as a business expense, show us that it was an actual legitimate expense that you needed to operate your business. Mm-hmm. Generally speaking, if it does fit in that box, yes, take advantage of those write-offs. They're there. And I met with some clients that they've left a lot of money on the table just because they've been they've been lackadaisical on looking at what is a legitimate write-off. But let's put the write-offs to the side. Let's talk about these qualified accounts that are available to the self-employed, whether you have employees or you do not, where you can defer money on a pre-tax basis or on an after-tax basis, aka Roth, and making sure that you understand the nuance behind it. So, Alex, let's talk about the list that we have in front of us here and the rules that we need to pay attention to.
Yeah.
Let's talk about simple IRAs.
Okay.
Now, simple IRAs, it's not a misnomer. I do think that when it comes to an low-hanging fruit to establish an account that you can defer money that is deferral limits above and beyond just a traditional IRA,
right.
A simple IRA a lot of times is a good choice, especially if you have employees.
It is, especially if you only have a few employees. You don't want to spend a lot of money getting it started. It's a fairly easy option. Now, I do need to give a caveat that some of these...
There's always a caveat.
Some of these, if you want to do them for the 2025 year tax year, you're too late. They had to be established by October 1st.
So let's imagine you're going into 2026 and you're like, crap, I missed my opportunity to set up a simple IRA for 2025, but going into 2026
get it started.
is long. I mean, obviously, probably get it started sooner rather than later. Start your preliminary planning now so you can hit the ground running right when you hit calendar year 2026.
Absolutely.
Can you set up a 2026 simple plan in December of 2025?
You can do it. Yeah, you can do all the paperwork to get it established, but then contributions couldn't start until 2026 payroll.
Roger that. Okay.
So, but yes, it's a really nice way to do it. There are some investment facilities that help facilitate it. It is what's really nice is each of the employees who is participating, including the owner, will establish their own account that's a simple IRA for the contributions to go into. Now, you don't send them, just down the road and find an account and you go to this bank and you go to that brokerage. You'll put them usually in one central location. So for payroll, it's easy to get the contribution.
So let's kind of talk about the logistical steps, right? Let's imagine I'm a self-employed person, right? I got 5 employees.
Right.
I meet with you, Alex, and I say, Alex, I'm running into some high taxable income. I've heard of this simple IRA. I want to do it. How do I set it up?
So
would I go to like a Vanguard or like a Charles Schwab, like an E-Trade? Like I would imagine that these brokerage firms or these custodians, if you will, from their account opening drop down, you're probably going to see a link that says for self-employed. And you click on self-employed, you're going to see this list of drop downs. You'll probably see a SEP IRA, which we're going to talk about, and you'll see a simple IRA. It is, no pun intended, is it as simple as click the simple IRA account opening button and then follow the flow to set it up?
Almost.
Okay.
There's a caveat in that there is an employer portion and an employee portion. The nice thing about these employees each setting up their own account is if they leave, there's literally nothing you have to do. It's their account. It's theirs. It's up to them to handle it. You just quit sending contributions to it.
So if I say, okay, I want to go ahead and establish this, let's say if I go with, let's just say Charles Schwab, just because that's the,
right.
I'm not endorsing them. I'm just saying, hey, that's the one I'm most familiar with. It's where I hold my personal accounts. It's where we manage most of our client money. We also use Fidelity, and I have an E-Trade account as well. But let's talk about when you actually go through those steps. Again, assuming you're a risk route, because this can paint the picture for you of, hey, if you want to do this, here's how you can do it. You establish the simple IRA, but also understanding that if you have employees, there's dollar amounts that you have to pay attention to so you are in compliance. This is the Real Money Pros. Stay with us.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. And putting together the right team to run your HR-related tasks can be expensive, let alone time-consuming. Enter Ataraxis PEO, your professional employer organization ready to tackle all your HR needs from payroll to benefits administration, payroll services, workers' compensation, and talent recruiting. They've got you covered. With Ataraxis, you gain access to a team of experts who handle the nitty-gritty of HR, freeing you up to focus on what you do best, growing your business and growing your revenue. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. So say goodbye to the stress of HR administration and hello to Ataraxis. Experience the power of a true business partner with Ataraxis PEO. Visit ataraxispeo.com. That's ATARAXISPEO.com. Ataraxis, elevating businesses for the benefit of all.
Looking to make your dream of home ownership a reality? Look no further than Academy Mortgage, your first choice home loan lender. Academy strives to offer the best rates and terms tailored to your financial situation. At Academy Mortgage, you'll be treated like family, not just another file. Navigating today's ever-changing housing market can be challenging, but their team is here to help. Experience the zero-down options, including loans with no mortgage insurance. They also provide specialized medical professional loans and unique 2-to-1 rate buydowns that reduce your monthly payment for the first initial years of your loan. And forget about dealing with brokers and middlemen. With Academy Mortgage, everything happens in-house, from origination to funding. Say goodbye to hassles and surprises. Begin your home ownership journey today by visiting them online at academymortgage.com. That's academymortgage.com.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Academy Mortgage, your first choice home loan lender.
I know you've been waiting a little bit longer than normal.
Jen's manicure spot needs an extra pair of hands.
Who's at the front desk right now?
Someone who's handy with everything from nail files to spreadsheet files.
Deidre's not coming in today, but we have that whole bachelorette party.
Indeed can help her hire great people fast.
I need Indeed.
Indeed you do. Instant Match instantly connects you with quality candidates whose resumes on Indeed match your sponsored job description. Visit Indeed.com/credit and get $75 towards your first sponsored job. Terms and conditions apply.
Wait, aren't these all charitable donations?
At Magda's Tax Prep, every person
I'd rather
counts.
not have to file for an extension.
She needs new auditors to maximize returns on her family time.
On itemized deductions. Hey, can someone help with these 1099s?
Indeed can help her hire great people fast.
And now,
I need
back to
Indeed.
the Real Money Pros.
On her family time.
I can't hear. Welcome back. This is the Real Money Pros. Sometimes technological issues feed in sometimes, which I think we're running into. So hopefully you could... a little bit of connections issue here, so you might be hearing a few things.
Stick with us.
Yeah, stick with us.
We're going to get this figured out.
Now. Okay, I think we might be back on track now. Perfect. Where do we leave off? Simple IRAs.
Simple IRAs.
Okay.
Yeah,
So
how simple is it?
Last segment, we were talking about simple IRAs. If you're self-employed, what's available to you? Talking about simple IRAs.
Yeah.
So it's a great option to have where, really, in my opinion, you compare this to a 401k because most people are familiar with a 401k, these higher deferral limits above and beyond than what you have with just a traditional IRA.
Now, the biggest difference, though, besides contribution limits, is that as an employer, it's kind of some checkbox options for eligibility. So the first thing is the employer has to set up the plan that's the umbrella over all these individual accounts. You may have like a specific plan number that the employees are going to use on their account so that it's coordinated as far as when the money comes in, they know where it goes. But you're also you get to pick. Do you want people to be eligible right away, after 1 year, after 2 years, if they earn this much money or more? So there's some limitations that way. You can't do like a 90-day eligibility. It's immediately or 1 year. So that's limiting in options, but it still is a really great way to get things started as an employer, especially if you have employees.
Okay, so let's imagine this scenario. I set up the simple IRA. I have 5 employees. I approach them and say, okay, as a company, we're going to offer this benefit to you. Obviously, I'm going to take advantage of it as the business owner. I'm going to be able to defer pre-tax money. What is the limits for 2025? Let's just use 2025.
Well, I was just looking these up. The simple actually for 25 is, let's catch up. That doesn't work.
16,500?
Yeah, 16,500 and 17,000 for next year. But the catch up this year is 3,500 and next year it's 4,000.
Okay,
so it's a little bit of an increase next
So
year.
significantly higher. More than double than what you would get on a traditional IRA. So that's a benefit to you as a business owner, where you have high taxable income. You're trying to find a way to reduce that. So you go ahead and set up the simple, and if you're under age 50, that you can do 16,500 on a pre-tax basis. Now let's enter in the employees. You have 5 employees, and rules are that you cannot just set up a simple IRA only for your benefit.
Right.
You have to make sure that your employees are able to take advantage of this. Now, they have the ability to choose whether they participate or not, correct? Okay.
Correct.
So you approach them and say, hey, we have this simple IRA. You as an employee, you can elect to choose this or not. If they decide to say, well, yes, I do want to contribute into this account as an employee, they elect what percentage of pay they want to go in there. So whoever's handling your payroll, they handle those logistics. So let's say Brian Smith, made up name, he's one of the employees, and he says, great, I want to take advantage of a simple IRA. And you say, okay, here's the paperwork that you need to fill out.
Mm-hmm.
So let's imagine, again, you're setting your simple IRA up at Charles Schwab. Then there will be Charles Schwab paperwork that they will fill out, or they can go online and set it up. And then they come back and approach you and say, hey, my simple IRA is established. Here's the account number that you need to defer the money into. And this is, let's say I'm going to do 5% of my salary or 5% of my pay. I want to go into my simple IRA. You have that information, your payroll, whoever's handling your payroll, whether it's in-house or external, they have that information. So every time you run payroll, 5% of that pay is automatically going into that employee, Brian Smith's simple IRA.
Now, your payroll company may not forward those contributions. They'll adjust the paycheck, and then you may, as the employer, need to send that where it needs to go as the second step. They don't always do it for you, but it's still, the hard part's getting it adjusted in the payroll.
Yeah, I think that's the main thing, like just making sure it's accurately calculated.
Yeah.
And then as far as the logistics of moving the money from the business account that you have that submits the payroll, that sends the money actual to the employee, same idea, but instead of 100% of it going to the employee, that 5% is going to get shaved off and go to wherever that simple IRA is
Absolutely.
held.
Now, don't sit on it. You can't just only send it a couple of times a year. You need to make sure you're sending it with every payroll.
What happens if you don't do that? Are you subject to penalties?
Yep.
Is that like an ERISA thing, or is that Department of Labor, or both?
It's kind of both.
Okay.
It's more Department of Labor.
Okay.
Yeah.
So You're deferring the 5% because that's what the employee said the amount of their pay they want to pay. Let's talk about the match, meaning the amount that has to come from the company, you as the employer. Now, keep in mind, you get to benefit from that as well as the business owner. Because remember, as a business owner, you are the employer and the employee in most cases. So if you set up a simple IRA and you're deferring your percentage of pay to max it out, you still get a match from the company that's going in. But you got to be cognizant. Okay, so you have to explain that.
Well, you're an employee. You have to treat all participants the same. That's that non-discrimination that they don't make you test for because you're going to follow the rules here. And it doesn't allow for things to happen that would only favor the owners. So if you're deferring as an employee, you have to get the same contribution as you are giving to your the other employees. So there's two ways the employer can put money in. And you get to pick every year which one you want to do. You just have to notify the employees in advance what you're doing.
Proper disclosure, right?
Yep.
Okay.
You can give the equivalent of 2% of pay to everybody, whether they put in or not. Really easy math. What's 2% of your payroll? That's the cost to you.
So that is the amount that you have to contribute on behalf of the employee from the company, whether they decide on their own to put money into the simple IRA or not.
Yep, if you choose to go that route.
Okay, so that's one way you can set up the simple IRA, saying no matter what, whether you are putting money in this or not, to take your pay, 2% of that is going to go in as your employer contribution.
Yep.
Okay. Is there a specific frequency in which you need to do that? Can you do that all at the end of the year?
Not at that.
Okay.
The other is the match, and this is what most employers select. The reason is they feel they want to give the money to the employees who are choosing to save for themselves as well. And so with that, it's a match of up to 3% of compensation that's contributed. So if you have an employee that's putting in 2%, you only put in 2. If they're putting in 5, you still only put in 3. So it's that 3%.
Now, as an employer, can you elect to go above that 3%?
Nope.
No. So 3%. And again, that 3% is if they are actively contributing.
Right.
Not the one. So 2% across the board, no matter what. And then 3% if they're participating.
If it's a match. You can, as an employer, elect to reduce that to down to 1%, like once every 5 years, if you have tight finances for the company and you need to.
Simple IRA. It's not a misnomer. Generally easy to set up, less administration, less fee intensive. When we come back,
still some rules though.
There's some rules. There's always rules that you need to follow when you're talking about the IRS, and you don't want to jack around with those rules, to be clear. Let's talk about SEP IRAs when we come back.
Okay.
Simplified employer pension. Keyword pension. Funded by the employer. Some very important nuanced aspects of that you need to pay attention to. Stay with us.
As we age, managing our finances can become increasingly complex with ever-changing tax laws, estate planning, insurance needs, and investment environments. At Apollon Wealth Management, their goal is simple: to help enrich your life with personalized, expert financial advice. With a nationwide network of advisors, they're committed to delivering the best solutions for your financial future. It's time to take control and get the guidance you deserve. Connect with an advisor today by visiting The Real Money Pros. That's therealmoneypros.com.
Did you have a tax strategy going into this year to help maximize your tax savings? I'm Jeremiah Bates with Tree City Advisors of Apollon. We consider key factors like required minimum distributions, Social Security, net unrealized appreciation, 1031 exchanges, and more. Because a good advisor should help you with more than just investment selection. Visit us today at treecityadvisors.com or call us at 208-888-1244.
Advisory services offered through Apollon Wealth Management, LLC, DBA Tree City Advisors of Apollon, an investment advisor registered with the Securities and Exchange Commission.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then use tax-free for all of your qualified healthcare expenses. That's why you need Lively. Our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
If you have a small business, Staples has your sign.
Banners for my bakery?
Staples has your sign.
Oh, posters for my new pet store.
Floor decals for a pharmacy.
Every day, Staples associates help every kind of small business create bold signs to make big impressions. And now get $10 off custom signs, banners, and posters when you spend $50 or more. This is your sign, so print it big at Staples. Ends 5/28. Visit staplesconnect.com/thisisyoursign for details.
Imagine financial advice without a sales pitch to buy something, and imagine a long-term financial plan focused on your goals, not somebody else's, and the day that you can leave your broker because you know how to do things on your own. At Tree City Advisors, we do things a bit differently than our peers. First, we help you define your purpose for investing. We help you clean up messes or complicated financial issues from your past. We help you organize all your financial pieces into something manageable. We're a fiduciary-only firm, and we
SEP
design
IRA.
simple strategies. And we teach you how it all works without clutter, confusion, or high costs. We can either do your investments for you or we can teach you how to do them on your own. In the end, we empower you with knowledge, lower fees, and confidence. Welcome to Tree City Advisors. This is the way we think if financial advisors should work for their clients. At Tree City Advisors, we provide flat fee planning and training. We also offer full service asset management, and we employ do-it-yourself technologies. There's never a fee for an initial meeting or review, so let's get started. Learn more at treecityadvisors.com. Tree City Advisors is an SEC registered investment advisor.
You're listening to the Real Money Pros.
And we're back. This is the Real Money Pros. Jeremiah Bates, joined with Alexander Lundgren. Well, yeah, I think we got our technology issues figured out.
Figured it out.
Shout out to our producer, Josh, who handled it. Shout out to Cooper, who's running the stream and also helping us get things set up. And shout out to Alex, who was backup. Brian was slated to join me. He was going to connect remotely. We were running into a few connection issues. Alex was, in fact, meeting with some clients or prospective clients on a Saturday, by the way, which I think is great. Making sure that they're set up, doing some preliminary planning, making sure they're on track for their retirement plan. And we kind of had you as a backup if needed, so stepping up to the plate.
Here we go.
Certainly appreciate it, Alex. Thank you. Okay, we're talking about employer plans. If you're self-employed, again, I will be redundant with this saying, but the reality is our tax code favors those who are self-employed, meaning
In a way.
In a way, yeah, I think it's well said.
When you pay both sides of Social Security, I don't know.
Yeah, but I think there's just more options. Like you can get much more creative, I would say. A lot more strategies that are available to you.
A few more levers you can play with, right?
If you're self-employed and you have these type of plans, or if you are looking to become self-employed, or you've been thinking about setting up a retirement benefit or some type of benefit offering, call the program. We are live 979-59-MONEY. That is 979-596-6639. Let's talk about SEP IRAs. We talked about simple IRAs. Again, these are great options, give you higher deferral limits, path of least resistance, in my opinion, if you want higher deferrals, especially if you have employees. But in all of these that we're talking about, you got to look at the pro-con analysis. You have to look at those percentages that you are beholden to contribute as a business for your employees. Factor that into your cash flow going into the next year. It's not just the tax savings you will recognize personally, but you also got to understand that could be a headwind for you if you have a lot of employees or highly compensated employees.
And know that any of those employer contributions are 100% immediately vested, meaning you put it in the account, it's out of your hands. It's theirs.
Okay, copy
They
that.
leave the next day, it's theirs.
So unlike a 401k where you could put some
vesting on it,
you could put some vesting, otherwise known as golden handcuffs, to where if I'm doing contributions as an employee for you, you got to be here for a period of time before that. Those funds are 100% for your benefit.
Right.
Let's talk about SEP IRAs. So we talked about this going into the break. That stands for Simplified Employer Pension. Keyword is pension. And when we're talking about pensions, that is funded by the employer. End of story. This is not being funded by the employee. Like, meaning the employee isn't going to say, oh, I want to participate in this SEP, so I want to contribute 5% into my SEP IRA. Not the case. This is all funded from the employer. Which, again, if you are a business owner and it is only you, or let's say a spouse, sometimes these are great options. But if you have employees, this is something you need to be very cognizant of. Alex, am I on the right track here?
Absolutely.
Okay.
Yeah.
Fill in the details or nuance to this.
Yeah. So the contribution amount it's considered, company money coming in, not payroll money, right? Can be up to 25% of what the wage amount is for the owner.
So if you're taking a W-2, right?
Yep,
So let's imagine. So I'm going to give you two different scenarios. You have an S corp and you have an S corp, which, generally speaking, if you're an S corp owner, you should be taking a reasonable wage, aka you get a W-2.
And reasonable.
Reasonable.
Like what you would pay somebody to do your job. If somebody won't do your job for $25,000, you better not be paying yourself $25,000.
Yes. So, and that's kind of the nice thing about an S corp is that you can identify that wage, make sure it's reasonable, and then anything above and beyond that, meaning your net business profit, you can just take as a owner draw, which is not subject to the FICA tax, aka your payroll taxes. So a lot of times, even if you have to take a reasonable salary, you're still getting that tax benefit from an S corp. Obviously, we're painting with broad brushes here. I'm not advocating for you to immediately go do an S corp. There's a lot more things that you need to look at. But let's just imagine that you are filing as an S corp. No employees. You're taking advantage of it. Let's say that you've come across a high tax year and I need higher deferral limits.
Yeah.
It's just taxes are too much of a headwind. I've been looking at a SEP IRA. It seems like this is much higher than what I can do. If, from my understanding, whatever you take as a W-2 wage, the maximum that you can put into that SEP IRA is 25% of that wage.
Yep. So if you pay yourself $80,000, the maximum employer contribution,
which is the only type of contribution,
the only kind
that
goes in is $20,000. Now there is a high end limit. So if you have a super high salary, still there is a maximum of, I think it's $70,000.
Yeah. So it's the lesser of the two.
Right.
Meaning if 25% of your wage, in this case your W-2, is higher than that $70,000, the max that you can put in there is $70,000.
Correct.
Or if it's lower, then the max you can do is 25% of that W-2.
Correct.
Now let's pivot to, let's just say, well,
a sole proprietor.
Let's just imagine that I'm a sole proprietor. I don't take a W-2 wage.
Yeah.
I don't have enough net business income to justify the tax savings that I could get through an S corp. So I just file as a sole proprietor, meaning I have an LLC, but it just all flows through to me as a sole proprietorship.
Right.
From my understanding, correct me if I'm wrong, the max you can do, again, you're still beholden to that $70,000 as a max, but 25% of your net business income, correct?
Mm-hmm.
Okay.
Correct.
So if you're a single person or if it's just you and your spouse, then you get the max benefit of it, right? I mean, because really your business is kind of an extension of you, and you get higher deferral limits, which is great. However, one thing to note with the SEP IRA is that it's funded by the employer, which means it's a business expense, which reduces your net business income, which flows through to you, which, little tax nuance here, it could affect your QBI, your qualified business income deduction, which for some businesses is up to 20%. And this is where we could look at doing a 401k, which could be more beneficial because that's funded by the employee, at least on the employee contribution side.
Well, and the other thing there's another pro of the SEP is that you have until the 15th of April to fund this. So you can sit down with your CPA and they can say, well, if you put in $1,732, it will save you X amount in taxes, right? They can really hone in on what that number is a little bit because there's time to do it.
Does the SEP IRA account have to be established in that calendar year?
No.
So let's imagine you meet with your CPA. Let's imagine we're March, beginning of April of 2026. You're getting everything scored away for 2025. Let's imagine you don't have employees. This is a scenario that I'm painting right now. And you go with the CPA and they're like, okay, here's how much you owe. And you're like, geez, that's a lot of money. I need to find a way to reduce my taxable income because that's a big check I'm writing to the IRS. That's where you insert the SEP IRA. And you can effectively calculate, well, here's the max that you can put in there based on your net business income or what W-2 you took. And if you put in this amount, here's how much it will reduce your taxes.
Right. How much of it do you get to keep by giving it to yourself instead of sending it off in taxes?
So then if that's the case, then you can say, great, you go to wherever you go. I mean, it could be a Fidelity, Charles Schwab, or whatever. Establish the SEP IRA and then do the contribution, mark it for 2025, and then that's calculated on your tax return. Good to go. Things keep moving, right? You get that tax savings.
Do not wait till the last day because although technically that's okay, I don't know many institutions that can pull it off.
Yeah, you don't want to be up against that 11th hour.
Nope.
I hate making movements in that in those situations. Now let's talk about SEP IRAs. But
downside.
If you have employees, the downside. What is it?
If you are doing a 25% of compensation to yourself for the contribution, you got to do 25% for your employees too. So the dollar amounts won't be the same necessarily, but the percentages have to be the same. So if it's 10%, then it's 10% the employees. It has to be the same.
So let's imagine that you did 25% for yourself as the business owner into your SEP IRA, and you have an employee. That's great. You pay them $100,000. Then as the employer, you need to contribute into their SEP IRA $25,000.
Absolutely.
Is it immediately vested?
It is immediately vested, but there is a cliff before they're eligible to receive it. So once they've been with you for 3 years, then you have to start doing this.
Okay, so that was going to be my next follow-up question. Is there any caveats to where, like, meaning let's imagine you hired someone for seasonal help. You hired them in November of 2025, and you have this SEP IRA established. Does that mean you have to contribute 25%? No. Meaning they have to be employed for 3 years?
Yes.
Okay. But if you want to go, if you did feel that, hey, I want to give them a SEP contribution, could you decide to do that?
Absolutely.
Okay.
Yeah. But once you start, you're in.
To summarize SEP IRAs, again, if you have employees, this could get expensive.
It could get really expensive, unintendedly so.
Yes. So pay attention to that. And also pay attention to if you don't have employees, yes, that SEP IRA gives you a higher deferral limit. However, you could entertain a individual 401k where you have the ability to do an employee contribution from you, the employee. That all comes from you as the individual, not the business. And you could, like, let's imagine 25% looking at the SEP lens allows you to put $20,000 in on a pre-tax basis. Well, in an individual 401k, you could do $23,500. And then if you're over age 50, you could do an additional $7,500 catch up, if I'm not mistaken. So again, nuance. These are things that need to be looked at. Who's looking at this for you? Who's helping you calculate which option is better? And maybe you've been doing something for so long, it's time to review to see if that sophistication has increased a bit, where we got to take a look, recalibrate, and strategize around SEP IRAs, 401ks, or simples. This is the Real Money Pros. We'll be right back.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. And putting together the right team to run your HR-related tasks can be expensive, let alone time-consuming. Enter Ataraxis PEO, your professional employer organization ready to tackle all your HR needs from payroll to benefits administration, payroll services, workers' compensation, and talent recruiting. They've got you covered. With Ataraxis, you gain access to a team of experts who handle the nitty-gritty of HR, freeing you up to focus on what you do best, growing your business and growing your revenue. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. So say goodbye to the stress of HR administration and hello to Ataraxis. Experience the power of a true business partner with Ataraxis PEO. Visit ataraxispeo.com. That's ATARAXISPEO.com. Ataraxis, elevating businesses for the benefit of all.
I know you've been waiting a little bit longer than normal.
Jen's manicure spot needs an extra pair of hands.
Who's at the front desk right now?
Someone who's handy with everything from nail files to spreadsheet files.
Deidre's not coming in today, but we have that whole bachelorette party.
Indeed can help her hire great people fast.
I need Indeed.
Indeed, you do. Instant Match instantly connects you with quality candidates whose resumes on Indeed match your sponsored job description. Visit Indeed.com/credit and get $75 towards your first sponsored job. Terms and conditions apply.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then use tax-free for all of your qualified healthcare expenses. That's why you need Lively. Our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
And we're back to the Real Money Pros.
We are back. TheRealMoneyPros.com is where you can find us. Brand new website, revamped. Take our Better Bucket assessment. Take our questionnaire. It's great. It effectively helps you see how we operate as a fiduciary advisory firm and how we approach investing. Simple, not complicated, clean visuals that we actually draw up, I would say 100% of the time in our offices, whether we're meeting with a prospective client or it's clients that have been with us for a decade or more.
Yeah.
BetterBuckets System. There's a better way to do this. There is a way where you can effectively strategize where your money belongs, how it needs to be invested, that balance of growth, income, and conservative liquid assets to make sure it all coordinates to your plan and what your plan looks like. And for each person, it's different.
It is different.
It's different.
It's different because it's where is your money? How much do you have? How much are you going to need? How much debt are you going into retirement with? All of those things change it. And so what your neighbor does may not be the right thing for you.
This also helps you avoid your self-definition of I'm conservative.
Yeah.
Like if there's one thing
Right.
that I've seen consistently, and I totally get it. I understand why, but it's standard where I'm approaching retirement or I'm in retirement. I don't have the ability to take on risk. I need to be conservative. I've done a number of plans.
If you're going to live for another 20 years, you have to still take on risk.
You took the words out of my mouth. I met with a client earlier this week. They retired late 50s, early 60s, basically sitting entirely in cash. And longevity's in the cards. Their parents are still alive, well into their late 90s. I said, Your money needs to effectively last you until you are at least mid-90s. So We're talking over 3 decades. This plan's not going to work. And to be clear, it is an investment decision. Just sitting in cash and letting emotions or fear not allowing you to effectively strategize, that is an investment decision. And in this case, didn't work. I've had some clients where it has worked, meaning they had enough, but they're leaving a lot of chips on the table. And arguably, they lived well below their means from the standpoint of if we can properly allocate, get that balance between risk, income, and conservative. I'll be the first one to tell you, don't take on more risks than what you need to.
Agreed.
Make sure you have plenty of liquidity at arm's length that gives you peace of mind, lets you sleep easy at night. It's hitting your needs.
For sure.
You're paying your utilities, your health care, your clothing allowance, your gas, your insurances, all of that. That is covered on a monthly, semi-annually, and annual basis. That is done.
Yep.
But I imagine you probably want to have some fun in retirement. You want to travel. You want to see grandkids. Your kid moves, so you want to go. You want to go visit them. You want to take some trips to Hawaii. You want to
If you're not going to do something, then why are you not working?
You want to buy a boat. You want
to have fun.
You want to buy a boat. Yes, and it's an extremely hard thing to switch on psychologically, is especially if you've been doing all those great habits, saving money, living below your means, setting up that delayed gratification.
Yeah.
And this is to be clear, this is how it is supposed to work.
Yeah, that's the plan.
Yes, you get to that point, and then when you cut the corporate cord or you retire, you're supposed to spend down. You're supposed to start using that money for your quality of life impact. And what I found is that a lot of people are hesitant to do that, which is totally normal, by the way, because you're doing a complete 180 from what you're used to, and it's unknown, and it could freak a lot of people out, or cause people to just not make a decision.
And the whole I don't know when I'm going to die and I don't want to run out is in the back of your head as well.
One of the best compliments or responses I can get from clients is that, great, I don't have to worry, or you made me feel so much better, or now I understand, or it's just like you see their like tensed shoulders. If you've ever gotten a massage, just like drop down, relax, deep exhale. I'm like, yes, you've got this. You've done all the right work. There's no mess here, not complicated. We just got to structure things in a way that you understand. That is the BetterBuckets System.
Yep.
Go to our website, realmoneypros.com, take the BetterBuckets assessment. And if you have any questions, send it our way. We're happy to respond. Again, phone lines are open, 979-59-MONEY. That is 979-596-6639. I'm Jeremiah Bates, joined with Alex Lundgren. We are fiduciary financial advisors. Obviously, we're talking about retirement accounts for self-employed, but if you want to change the topic, you want to talk about estate planning. I've had some really good estate planning conversations with a few clients over the past few weeks. You want to talk about investing. Did find this interesting that President Trump is set to reclassify marijuana from a Schedule 1 to a Schedule 3, and we saw a surge in a few cannabis-related companies. So I could throw a question out to the listeners there. Does this entice you at all to explore this investment space of marijuana stocks that have been significantly beaten up over the past few years? I will say that. Again, love to hear your thoughts. 979-59-MONEY. Alex, let's talk about 401ks. We talked about simple IRAs. We talked about SEP IRAs. Now, for those who are self-employed, this is who we're talking to. Let's talk about 401ks. What are the pros, cons, if you have employees, if you don't have employees, how you should view this?
So if you don't have employees, it's just you and or your spouse, and there are literally no employees. You can't have any.
1099 is okay.
Yep.
Like 1099 individual, okay. Like independent contractors that you're paying. Obviously, those do not classify as employees.
Right.
Pay attention to that, by the way, because you don't want to cross that line.
You do not. And there's they're watching that.
Yes. But again, under the assumption that it's just you or you and a spouse.
Correct.
No employees.
Then you can do what is called either a solo K, an individual K. There are different terms for it, but it's a 401k, so you get the contribution limits of the 401k, which are much larger, but you don't have employees, so you don't have to do any of the testing or the different things that you would pay the administrative company to do.
So let's talk about that a little bit, because when I'm meeting with self-employed clients, I think it's an important thing that I like to explain is that generally speaking, when you are self-employed and you have a few employees and you want to set up a 401k because you as the business owner want to take advantage of these higher deferral limits, which helps you on your personal tax return. The issue with it is it's cost prohibitive.
It's expensive.
And the reason why is because you have to insert other players into the situation that make sure you're compliant, because now you're entering ERISA world, which is the
Employee Retirement Income Security Act.
So they set the rules and reporting requirements that you have to follow, and there's a lot to it. And you also have third-party administrator, you have a record keeper. If there's a certain balance, you need to file certain tax documents, meaning
it's a lot of work.
It's a lot of work, and generally speaking, you need to hire people or companies that are experts in that space that handle it for you to make sure that it's done right, so you are in compliance. You are not in a violation of everything that could come back and run into steep penalties. So
absolutely,
and it's serious. I mean, you can't just be haphazard about that. It's very important. So now when you look at...
And not only could you end up with fines and penalties and stuff, if they disqualify the plan back to the beginning, now you got all those years of contributions that are no longer tax deferred. And the mess.
Well, and the liability too, because if you're an employer and you set up a 401k, generally speaking, that 401k, it's like almost on its own. Think of it like a trust that is for the benefit.
That's exactly what it is. It's a trust.
It's for the benefit of the participants.
And their beneficiaries.
And then who's the trustee that's in control of that trust that has a fiduciary obligation to make sure that they're doing everything right per the rules that are set, that they're setting this plan up for the benefit of the employees?
Yeah, you don't get cheap here because this is unlimited personal liability. It will not stop at the corporation.
For the business owner or business owners, for that matter. So that's why it's very important that we make that distinction. So now when you enter in the solo 401k, a lot of that's pushed to the side because there's no employees. It's just you and maybe your spouse. So that's the benefit of setting up the solo 401k. You get higher deferral limits. You can also do profit share contributions, which come from the employer. Yep. Obviously, there's limits that you have to be beholden to on that, depending on how you structure your filing. It's important, but solo 401ks are great. A lot of custodians like your Schwab's, Fidelity's, your E-Trade, they have off-the-shelf documentation that you can go up, set up that individual 401k, and you're ready to rock and roll. Now remember, for that plan to get you, if you're taking a wage, you got to set it up and fund it before the end of the year. If you're not taking a wage, say sole proprietor, establish a solo 401k this year, and you have up until some deadlines of 2026 to make your previous year contribution. A lot of moving parts. If you need help, this is what we're here for. TheRealMoneyPros.com. We will be back next hour. Stay with us.
The Real Money Pros is hosted by Brian Wiley and other team members of Tree City Advisors of Apollon. Tree City Advisors of Apollon is a DBA of Apollon Wealth Management, an SEC-registered investment advisor and affiliate of the Real Money Pros. The Real Money Pros and Tree City of Apollon are not affiliated with any of the companies or non-advisor professionals participating on this program. Ataraxis PEO and Apollon Wealth Management are financial sponsors of the Real Money Pros. Additionally, Apollon receives advisory fees for these sponsors and or their representatives for investment advice. Log into therealmoneypros.com to contact the host for advice, show archives, educational material, and more. This program is brought to you by the quality sponsors heard within this broadcast.
Businesses today face a barrage of challenges. They hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. Ataraxis partners with businesses of all sizes and industries. Their mission? To reduce the stress and risk that comes with business owners trying to do it themselves. Visit ataraxispeo.com. Ataraxis, elevating businesses for the benefit of all. Apollon Wealth Management has helped me and my team change the way we conduct our advisory business. The result? We believe we are better equipped to provide the highest level of quality financial planning, investment management, and comprehensive financial advice than ever before. Apollon has been instrumental in our efforts to assist clients in achieving their distinctive financial objectives. If you're an advisor seeking to improve your client experience or an investor seeking to elevate your wealth management to a higher personal standard, contact us at The Real Money Pros. That's therealmoneypros.com. Imagine financial advice without a sales pitch to buy something. Imagine a long-term financial plan focused on your goals, not your investment professionals. At Tree City Advisors, we do things a bit differently than our peers. First, we help you define your purpose for investing. We help you clean up messes and complicated financial issues from your past, empowering you with knowledge, lower fees, and confidence. We design simple, effective investment strategies, and we teach you how it can all work without clutter, confusion, or high costs. Welcome to Tree City Advisors of Apollon. This is the way we think of financial advisors should work for their clients. At Tree City Advisors of Apollon, we provide flat-fee financial planning and training. We also offer full-service asset-based investment management, and we employ do-it-yourself technologies. Visit treecityadvisors.com. There's never a fee for an initial meeting or review, so let's get started. Learn more at treecityadvisors.com. Advisory services offered through Apollon Wealth Management, LLC, DBA Tree City Advisors of Apollon, an investment advisor registered with the Securities and Exchange Commission.
market to buy a house or just looking to refinance your current mortgage? For helping individuals and families achieve affordable homeownership, Academy Mortgage is a first choice. And when finding that perfect loan for the perfect home, you need a company that will treat you like family, not just another file. To help you navigate through today's ever-changing housing market, Academy Mortgage has zero down options available to you. That includes zero down with no mortgage insurance. We also offer medical professional loans and 2-1 rate buy-downs that help lower your monthly payment for the first several years of your loan. Origination, processing, underwriting, and closing and funding will all happen in-house. With over 34 years in the business, we know that buying a home is more than just a house. That's why it's important we protect our customers and safeguard their financial wellness for years to come. Visit us online at academymortgage.com today to start your journey to homeownership with Academy Mortgage. That's academymortgage.com. Academy Mortgage, your first choice home loan lender.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
To offer valuable advice and earn clients' trust as an advisor, it's essential to always put their interests ahead of personal gain or the preferences of any particular company. Advisor Insurance Solutions is dedicated to delivering insurance solutions from an advisory perspective. They provide objective and unbiased insurance planning, making it an integral part of their comprehensive advisory process. If you're looking for insurance guidance that aligns with your financial goals, visit therealmoneypros.com. That's therealmoneypros.com.
Nobody protects you from mayhem like Allstate. I'm a speed bump. Did you hear what I said? I'm a speed bump. And if you have cut-rate car insurance, the cost to reattach your muffler could really be a bump in the road. So switch to Allstate, save money, and be better protected from mayhem, like me.
Based on coverage and limits selected, subject to terms, conditions, and availability. In most states, prices vary based on how you buy. Allstate Bar and Casualty Insurance Company and affiliates, Northbrook, Illinois.
Running out of gift ideas for your loved one? Send flowers with Flower Fix. And need to create joy in your living or workspace? With many working from home these days, create joy in your space with flowers. Flower Fix is a subscription-based flower delivery service perfect for birthdays, anniversaries, or any special occasion. We offer 2 subscription options to choose from, a text-based subscription or a traditional one. Enjoy these big, beautiful hand-designed bouquets that are delivered straight from our flower fields to your door. Log on now, www.flowerfix.com, to choose your flowers today. Have control over when you want flowers delivered. Weekly, bi-weekly, monthly? Get your Flower Fix at flowerfix.com. Use code FlowerFixPro to receive 20% off your first order. flowerfix.com.
I know you've been waiting a little bit longer than normal.
Jen's manicure spot needs an extra pair of hands.
Who's at the front desk right now?
Someone who's handy with everything from nail files to spreadsheet files.
Deidre's not coming in today, but we have that whole bachelorette party.
Indeed can help her hire great people fast.
I need Indeed.
Indeed you do. Instant Match instantly connects you with quality candidates whose resumes on Indeed match your sponsored job description. Visit Indeed.com/credit and get $75 towards your first sponsored job. Terms and conditions apply.
Healthcare expenses can be a burden, so why not make the most out of the money that we'd spend anyway? Take advantage of the most powerful tax advantage account title available to us, a health savings account, also known as an HSA. That's why you need Lively. Visit Lively right away. Open your HSA, roll other HSA money into that new plan, and then start saving. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO.
Hi, I'm Stephanie Gallegos with Price for Life. Do you have a life insurance policy that you'd like to sell? If you don't need the coverage anymore or would rather not keep making the premium payments, visit our website, priceforlife.com. Don't let your policy lapse when you can potentially get a cash payment for it. There are several reasons why a life settlement might be a great value to you. Perhaps your policy is too expensive, or you feel you no longer need the death benefit, or you may think you need to wait until death before your family can get the money from the insurance company. This is why you may want to consider a life settlement. Price for Life has excellent resources available along with a free evaluation process to help you understand the value of your policy and the options available to you. Price for Life's clients have received hundreds of thousands of dollars for their policy when they would have otherwise just let it lapse by stopping the premium payments. Get the compensation you deserve. Visit priceforlife.com today and fill out the case evaluation form to see if your policy qualifies. That's price, the number 4, life.com. Priceforlife.com.
Money Pros is brought to you by The Real Money Pros and the sponsors heard within this broadcast. Material presented on this program may not be suitable for you. Consult a registered investment advisor when evaluating any particular investment, security, or investment strategy. The views, opinions, or advice offered by the hosts and guests do not necessarily reflect those of this station. Brian Wiley and Jeremiah Bates are investment advisor representatives with Apollon Wealth Management, an SEC registered investment advisor. The Real Money Pros with Brian Wiley and Jeremiah Bates, the weekend's smartest money show. Investing, taxes, legal topics, insurance, and every other confusing money topic made simple.
Welcome back to the Real Money Pros, hour number 2 of our 2-hour live program. Live meaning you can interact with us. Call the program 979-59-MONEY. That is 979-596-6639. I'm Jeremiah Bates, fiduciary financial advisor, joined with my colleague Alex Lundgren, fiduciary financial advisor as well, our resident Social Security expert. Retirement plan for self-employed people expert, as I would like to say, an expert on a lot of other things. Alex, when we were talking during
what happens when you get old and do it a long time, Jeremiah.
There's this the Berenstain Bears book series it's a big favorite of my daughter Tori, so we've been reading that, and there's a book where the 2 little cub bears, they go visit their grandparents, and that's one of the comments in one of the pages where the kid asks, "Grandpa, why do you know so much?" He's like, "Well, that's the great thing about getting old. This is the older you get, the more things you know."
Right. Yeah.
So interesting number that you put out there that we were talking about during the break, and it was specifically a statistic that I find incredibly interesting around Social Security.
Yeah, so a single person, no survivor benefits, no ex-spouse, no spouse, just a single person who is between the ages of 62 and 70 looking at options for filing for Social Security has 97 different options, okay? If you now add in a second person, you've got a spouse and different earnings and different ages and all those things, your options now exceed 9,000. So maybe your neighbor's decision and yours aren't the same. That's a lot of choices.
It's almost too many.
For sure.
What is that? It's like the theory around limiting choices makes decision making much easier.
For sure.
Like if you're looking at like a menu lineup or a product service offering, where if you have 10 versus 3, it's like paralysis by analysis,
For
right?
Sure. Yeah.
And it's a prime example where I met with some prospective clients last week, and they already had the assumption in their head. It's like, gonna file at 62. I'm like, well, let's pump the brakes on this. And
right.
I just barely scratched the surface of just maybe 3 or 4 different filing options that they would have, because they're married, one's self-employed, one's looking to retire sooner than the other, one's Social Security benefit is higher than the other, one's looking at spousal benefit, one's not. Maybe we could look at delay, one file, one delays. Take advantage of all that. And he just kind of looked at me like, wow, I never thought about that. I was like,
right.
Most people don't, and Social Security is not black and white.
It's not.
The numbers are there.
Yeah.
I mean, potentially 9,000 different filing options when you're married and you have a spouse for filing options. It's almost mind-boggling.
Yeah.
So, and Social Security is one of those things where it needs to be looked at because the stakes are high. Once you make that election, generally speaking, you cannot come back and unwind it. So
right.
You need to make sure that you're doing the analysis, making sure that Social Security is looked at in conjunction with all of your other resources. Do you have a pension? Do you have other retirement accounts? Do you have real estate that you're going to sell that are going to cause taxable events in a certain year? Meaning that tail should wag the dog of when you file Social Security. The best way I'd like to say this is don't look at Social Security on an island on its own.
Absolutely.
Look at the options and how those options coordinate with everything else, which will lead you to the best sequence of filing.
And health and longevity expectations, and which spouse is going to live longer and how much longer potentially. All of those things really need to be part of that decision.
Social Security questions, call us 979-59-MONEY. That's 979-596-6639. As we approach the end of the year, we need to look at items that may have some urgency on them to get them done before the calendar hits December 31st, 2025. Generally speaking, if you wait until the calendar year of 2026 to make some strategic tax moves, that opportunity is long gone. So December, you still have you've got a couple weeks to effectively get some things done. So let's talk about health savings accounts, medical savings accounts, flexible spending accounts. You know, you have these acronyms for these, and like the terms are so extremely important. I would say this, when we're talking about a health savings account tied to a flexible spending account, HSA.
Yeah, this is where you get the most confusion.
You get to keep. HSA you get to keep, meaning if you do not, the money that you put into the HSA, again, assuming you have an HSA eligible healthcare plan, as long as you check that box, you can fund an HSA, which I highly suggest you do.
Best tax move you can make.
In most scenarios, if you're looking at the order of the prioritization of what type of account should I defer money into first, hard to argue against an HSA.
Absolutely.
And the reason why is because the money that you put into it reduces your taxable income. You can, in fact, invest your HSA money. So you could use this as a long-term tax-deferred growth vehicle. You don't have to do it with all of your money. Like you could, again, bucketize it, look at the timeline of when you need to use the money, and that will help determine how you invest your money or if you invest your money. You could look at an HSA as the same way, where if you're like, well, I need that money because my deductibles are kind of high and I need this source of liquidity to pay for these things. I've been there. I totally understand that.
Yep.
So strategize.
It's okay to use the money.
Yeah, of course. But again, strategize what that amount is. Keep that at arm's length. And then anything above and beyond that, yeah, 100%. You should probably go invest it.
Now, you said something that's really important I want to call the attention on. So, I mean, I could go on to Fidelity or Schwab's website and open an HSA. That doesn't mean I am eligible. You have to be participating in a high deductible eligible health care insurance plan to legally put money into this HSA.
Correct. And you have to be under 65.
Yes.
Too. So that is one thing. If you're 66, you're like, oh, I want to put money in the HSA. You can't. You can use the money out of your HSA past 65, but as far as continued contributions, that sunsets when you turn 65. Reason why? Because generally speaking, you're on Medicare and you're not on that type of eligible healthcare plan. You get it. But again, the reason why I prioritize HSA, the contributions that you put in reduces your taxable income for the year you did that contribution. If you invest that money, all those gains are tax deferred. And then when you eventually pull the money out, assuming it's spent on an eligible healthcare expense or it's reimbursing yourself from a previous medical expense that could have been 5-10 years prior, that money comes out completely tax-free.
Yeah,
so
tax-free in, tax-free out.
Triple tax savings. There's no other accounts that offer that level of tax savings. So it's a great option. Again, assuming that you're eligible. But bottom line is, you use an HSA, that money stays with you. Not unlike a flexible spending account.
Correct.
Which is?
It's a spending account. It is an amount that you can put in, and it's pre-tax going in. When it comes out, it's tax-free as long as it's for the the eligible expenses. But it needs to be spent during the year. There is a limited amount that can carry over. For 2025, it's $660. If at the end of the year you still have $1,000 in your account, January 1, you have $660. You cannot carry over a larger amount than that. You need to actually spend it.
Prevent forfeiting your flexible savings account dollars. Like, let's imagine that you funded it and maybe you used a little bit of money throughout the year and then it became an afterthought and you forgot about it.
Yep.
Don't forfeit those dollars. Go back and do an audit for medical expenses that you may have not used your flexible savings account for, because you can effectively reimburse yourself for those expenses. Like, I do know sometimes those flexible savings accounts, they come with a debit card and, they didn't approve it because it was some weird payment processing, or maybe the way your FSA works, they don't allow, like you have to submit receipts and you thought, okay, I'll submit it, but life hits you, kids, sports, work, and you forgot about it. This is a great time. Go back, do an audit, see if there's any medical expenses, doctor visits, glasses, prescriptions, co-pays, therapy, lab work, dental,
contact solution, over-the-counter medicines, feminine hygiene products, all of that kind of sunscreen. You can even go to Amazon and find an FSA acceptable items only list. So if you've got money that you don't have a medical expense for and just need to spend it, stock up on stuff you're going to use.
Same thing with your health savings account as well.
Yeah.
It's same scenario. Now, again, the one benefit you have in your back pocket is that the HSA money will stay with you until you die, and that will even be inherited by your spouse when your non-spouse inherits it. We're talking about different tax classification of those dollars. However, in that same regard, go back and do an audit, meaning if you paid out of pocket for eligible healthcare expenses, like let's say on a rewards credit card, and you had that cash in your HSA already earmarked to cover that, reimburse yourself for it.
Yep.
Pull the money out. And now, again, that doesn't necessarily have to be done the calendar year. You could actually let that carry over into 2026. That's fine. But hey, if the money's there and you made those expenses and it's top of mind because we are now bringing it up, strike while the iron's hot. And keep in mind, for an HSA contribution, you have up until April 15th of 2026 for your 2025 contribution. We'll be right back.
Make this year that you work smarter, not harder, with Ataraxis. As your strategic partner, Ataraxis becomes an extension of your business, taking the burden of HR, payroll, benefits, workers' compensation, compliance, and staffing off your plate. You'll have more time to focus on operating and growing your business. Let Ataraxis handle the details so you can focus on what matters most. Learn more at ataraxis.com. That's ATARAXIS.com.
As we age, managing our finances can become increasingly complex with ever-changing tax laws, estate planning, insurance needs, and investment environments. At Apollon Wealth Management, their goal is simple: to help enrich your life with personalized, expert financial advice. With a nationwide network of advisors, they're committed to delivering the best solutions for your financial future. It's time to take control and get the guidance you deserve. Connect with an advisor today by visiting The Real Money Pros. That's therealmoneypros.com.
Looking to make your dream of home ownership a reality? Look no further than Academy Mortgage, your first choice home loan lender. Academy strives to offer the best rates and terms tailored to your financial situation. At Academy Mortgage, you'll be treated like family, not just another file. Navigating today's ever-changing housing market can be challenging, but their team is here to help. Experience the zero-down options, including loans with no mortgage insurance. They also provide specialized medical professional loans and unique 2-to-1 rate buydowns that reduce your monthly payment for the first initial years of your loan. And forget about dealing with brokers and middlemen. With Academy Mortgage, everything happens in-house, from origination to funding. Say goodbye to hassles and surprises. Begin your home ownership journey today by visiting them online at academymortgage.com. That's academymortgage.com.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Academy Mortgage, your first choice home loan lender.
This open enrollment, start making meaningful progress towards your long-term financial goals. Did you know that a health savings account, or HSA, is the most tax-advantaged account in the U.S.? Contributions are tax-deductible, which reduces your total taxable income. Withdrawals for eligible health expenses are also tax-free. And last, capital gains on investments are also tax-free. Did we also mention that it's free for individuals? Visit livelymee.com/pro today. That's livelymee.com/pro.
And now, back to the Real Money Pros.
Welcome back to the Real Money Pros. Questions? Call us. 979-59-MONEY. It's 979-596-6639. And if you call in, you're talking with fiduciary financial advisors here only to work in your best interests. You have questions, we might ask you a few follow-up questions to make sure we're effectively giving you the best advice. Whether you want information on health savings accounts, flexible spending accounts, the best way to strategize that approach. You have questions about Social Security. Alex mentioned a wild statistic at the beginning of the hour was if you are going into retirement and you have a spouse, or you can take a spouse benefit or whatever, there's over 9,000 different filing options that you could consider. So it's something to pay attention to.
Yeah.
Again, therealmoneypros.com is where you can find us. It's where you can get access to our sponsors. We are a sponsor-driven program. We are not here to sell you anything. You can look at our archive shows, our previous episodes, where we talk about retirement, trust, estate planning. We talk about tax efficiencies, investing. You name it, we're probably going to have some episode or some video that covers that. Sign up for our newsletter. Alec, who's a great advisor on our team, does a great job making sure consistently putting in educational content on there regarding taxes, health insurance premiums. How do you effectively use 529s? We have it in there. Also, you can take an assessment around our BetterBuckets system. Again, I talked about this in our last hour, where one thing that I see a lot of investors do is they almost pigeonhole themselves or define themselves in what they deem is who they are as far as an investor, meaning I'm conservative, or I've heard this, so meaning I need to do this, or I need to do that, or maybe you're too aggressive and you're chasing, letting some the idea of outsized returns on this investment set your strategy. I would say a lot of times these don't work. Right. Or maybe they do, but at least if you do the planning and you understand the timing of all this, then you could arrive at a point where you are okay to be a little bit more conservative, or you are okay to take a little bit more outsized risk. Meaning,
don't be like conservative when the market's bad and aggressive when the market's good, because you will end up selling low, buying high, and that's not good.
Ultimately,
have a plan.
We're here to give advice that's built for you. And our sponsor, Apollon Wealth Management, we have fiduciary advisors across the country where, again, these things that we're talking about, let's imagine if you're listening to us cover, whether it's the last hour, you're a business owner, we're talking about all these different retirement accounts that you can set up for you and your employees, or you're hearing us talk about health savings accounts and flexible spending accounts, and it's starting to spur some questions in your mind, or you're thinking that, okay, I got to do this, but
how does it apply to me?
But it's like that first step of, okay, how do I do this? And is this the best move to make? I would argue that, and Alex, correct me if I'm wrong. You might be in a different side of this, but generally when I meet with clients for the first time, I can extract these in like the first hour and a half of meeting, because we know this like the back of our hand. We're doing this every day. Starkly different where I had to have a plumber come in because our garbage disposal was leaking from the bottom, and I'd like to consider myself a handy guy. I'm like, I'm not touching that. I'm gonna hire. And he was
water
in and out.
damage. You do not mess with.
And he was in and out. Bing, bing, bada boom. It was great. I mean, because he probably does that over and over and over and over again. So we're talking about advice built for you. Yeah, it truly is. There's gonna be a lot of questions that are asked because you got to look at the whole landscape, and then that leads to the strategy that's in your best interest. And I don't care what it is, if it's strategizing health savings accounts of how to invest it, when to pull money out, flexible spending, medical savings accounts. You may be in a state where it offers a tax advantageous MSA, medical savings account, meaning if you put money into that account, it will reduce your state income.
And usually they have a little bit different spending rules on them than the others do. So, and I just want to say that it's just because we can figure it out quite often in this first hour and a half of meeting with somebody, we're not going to figure everything, but we'll see some low-hanging fruit as the term goes. It doesn't mean it's easy. So what's happening is people are getting our 20, 30, 15 years of having seen multiple situations every day and being able to pinpoint these things, because I feel like sometimes when people sit with us, they're like, well, that was so easy. Is it really that big of a deal? It's a big deal. It took 10 years to be able to see it that easily on our side.
Yeah.
So when we are talking about these things, they are big, and it is a matter of figuring out how do we get it started? What applies to you? Should you fully fund it? Should you partially fund it? All of those things specific to you, it is a big deal.
And this is stuff outside of the direct investment protocol.
Has nothing to do with how your money's invested. This is all in addition to.
Yeah, I do find it interesting when I meet with someone, especially for the first time. It's like they almost push the investment statements right in front of you. The first thing, well, here's what I'm investing. I'm like, okay, that's great. And if they really want to focus on that first, okay, let's talk about actually how simple this is. And this is where the BetterBuckets System comes in. Like, this doesn't need to be complicated. Let's remove all the industry jargon And let's look at this as truly as simple as it needs to be. You have 3 different compartments for your money that are all going to coordinate together based on your plan. So once we dial in the plan, or you have a plan dialed in, then you can effectively solve for, logic yourself into how much money goes into each bucket. And that's going to be different for each person depending on what season of life that you're in. But you're educated. You have a clean visual that's simplistic and easy to understand.
And why you're invested the way you are. Not just where you're invested, why.
It helps you understand then why you're invested. It helps you understand what you own because your why is defined. It helps you understand the characteristics of those investments, meaning, is it up? Is it down? Is it supposed to do that? Is it not supposed to do that? Is my retirement plan completely messed up now that
is it going to pay me interest?
Yeah. Are we in a bear market? Can I sustain that? Does that mean I need to pivot? Like, what's our? No, like I said, there's a better way to do this, and that's where the BetterBuckets System comes in. And we've used it in our firm for years. COVID, it works. It works, especially when you're approaching or you're in retirement. Those concerns are cast to the side.
Yeah.
Like when we see big market events, I mean, knock on wood, hopefully we don't see another one, but we know it's not when, or it's not if, it's when.
It's when. Yeah, we don't make long-term money moves for short-term situations.
Exactly. But I would argue, and we work with a lot of clients. Most of them are not.
Very few phone calls when the market does weird stuff. And sometimes it's like, we got to buy.
Yeah, a lot of them is, how can we be opportunistic around this? Should we look at doing Roth conversion, some tax loss harvesting? It's like I explained, the last thing you want to do is if you see a market event, just being concerned or worried of, number one, you want peace. You want peace of mind that your whole plan is working and your investments are coordinating to that plan. And then also, how can you be opportunistic? I mean, every market environment is going to offer opportunities, even if the market's down. Like, you can make effective moves. So again, setting that strategy is extremely important. So go to therealmoneypros.com to learn more about the BetterBuckets System. Access our previous educational content. It's what we're here to do. It's what we do on the radio. It's what we do with clients. Make sure you understand, you are educated. The more education you have, the more fear and uncertainty is cast away and better decision-making is made. Emotions are not involved. I'll put it this way. When you're making decisions in a heightened emotional state, and there's not very many things that trigger emotions like money, so
don't do it.
Easier said than done, but that's where a strategy and the BetterBuckets System comes into play. So again, therealmoneypros.com is where you can get more. When we come back, let's talk about the market. We've seen some volatility. Could there be some opportunities? And are we seeing a bit of a rotation out of the high-flying technology sector into value stocks? Value? We'll be right back. Apollon Wealth Management has transformed the way our team delivers financial advice. With their support, we're more equipped and more empowered than ever to provide top-tier financial planning, investment management, and personalized financial guidance. Apollon has been a key partner in helping us achieve our clients' unique financial goals. Whether you're an advisor looking to enhance your client experience or an investor ready to take your wealth management to the next level, reach out today to The Real Money Pros by visiting therealmoneypros.com. Let's elevate your financial future today.
I'm Nick Daniels with Tree City Advisors of Apollon. My team and I help our clients implement tax-smart strategies because taxes are one of the largest headwinds your investments face. We use strategies like Roth conversions, 1031 exchanges, and more because a good advisor should help you with more than just investment selection. Visit us today at treecityadvisors.com or call us at 208-888-1244.
Advisory services offered through Apollon Wealth Management, LLC, DBA Tree City Advisors of Apollon, an investment advisor registered with the Securities and Exchange Commission.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then then use tax-free for all of your qualified healthcare expenses. That's why you need Lively. Our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
Begin your home ownership journey today. Look no further than Academy Mortgage, your first choice home loan lender. And forget about dealing with brokers and middlemen. With Academy Mortgage, everything happens in-house, from origination to funding. Say goodbye to hassles and surprises. Their team of seasoned professionals will be with you every step of the way. That's academymortgage.com. Academy Mortgage, your first choice home loan lender.
Academy Mortgage Corporation, NMLS 3113, is an equal housing lender.
Imagine financial advice without a sales pitch to buy something, and imagine a long-term financial plan focused on your goals, not somebody else's, and the day that you can leave your broker because you know how to do things on your own. At Tree City Advisors, we do things a bit differently than our peers. First, we help you define your purpose for investing. We help you clean up messes or complicated financial issues from your past. We help you organize all your financial pieces into something manageable. We're a fiduciary-only firm, and we design simple strategies. And we teach you how it all works without clutter, confusion, or high cost. We can either do your investments for you or we can teach you how to do them on your own. In the end, we empower you with knowledge, lower fees, and confidence. Welcome to Tree City Advisors. This is the way we think if financial advisors should work for their clients. At Tree City Advisors, we provide flat fee planning and training. We also offer full service asset management, and we employ do-it-yourself technologies. There's never a fee for an initial meeting or review, so let's get started. Learn more at treecityadvisors.com. Tree City Advisors is an SEC registered investment advisor.
You're listening to the Real Money Pros.
Welcome back to the Real Money Pros. You have questions, call us. We are live and phone lines are open. 979-59-MONEY, 979-596-6639. If you're wondering what moves you should make before the end of the year, what can move the needle the most from tax savings, well, we can give you that answer. You have questions around investing, what the markets are doing. We had an interest rate cut, 0.25%, 25 basis points from our central bank. How do you feel? Do you feel that this is going to translate into lower mortgage rates? Are you worried about that return on your cash? I've had a lot of clients that have been happy with those returns they've seen on CDs or maybe their high-yield savings. Are those set to sunset? And does that make you concerned? What's your plan? 979-59-MONEY. That is 979-596-6639. I'm Jeremiah Bates. She is Alexandra Lundgren, here for you. Visit therealmoneypros.com, sponsor-driven program. It's where you can get access to Apollon Wealth Management and AdderAccess PEO. We're here to educate, not sell. What's another word we had? We're not here to sell. We're here to guide. I really like that saying. Let's talk about market reaction this week. Obviously, Federal Reserve delivered what was to be. It was baked in.
Yep, people have expected this for some time.
Expectation is that the Fed was going to cut interest rates by 0.25%, which was delivered and, again, widely expected. You know, and I was surprised to see we saw a bit of a market reaction based on that to the upside. Now, this activity that we've really seen maybe this week or over the past week is not some selling pressure in certain sectors. And it's the sector that has been the high flyer this year, and it's been technology. And when you look at the optimism around artificial intelligence and how it's going to make things more efficient, companies more profitable, I mean, however you want to name it. And I'm curious. I would love to hear people's thoughts. And I met with a client who, I'm not going to mention the company that she works for, but she was not as optimistic on the savior that AI is supposed to be, or the efficient mechanism that it's supposed to be. And she said, listen, the way they're selling this is not reality. A lot of people aren't using it. It barely even helps with this. It barely helps with that. And the fact that this company is touting that AI is going to be this, and she's like, it's all bogus. It's all BS. Love to hear your thoughts. 979-59-MONEY, 979-596-6639. But I do think there's some levels to this, because
for sure,
I think you could look at the concern around the market is that it is overvalued, meaning when you look at the stock price compared to what the actual earnings are of its underlying constituents, you're starting to see a bit of a disconnect. And you can look at this historically. This has led to, and again, you can't look at this on an island on its own. It's not that, there's such a dispersion between the valuation and the stock price that it's ultimately going to lead to a giant pullback.
Right.
Not necessarily the case. But you could argue that, if Wall Street or investors begin to lose patience on the investment that these companies are making in this type of technology, and that then translating into earnings. Because when you look at a stock's price, it's based on what its future earnings are anticipated to be. It's a discounting mechanism. So you could see a scenario where, there is patience loss. It's like, hey, you haven't delivered. Like, we set the expectation. That expectation was not met. And now we need to reprice because the optimism around AI just wasn't what it was thought to be.
Think about it. You're developing an orchard, right? And you've put all the money in to get the land ready. You put in the baby trees. They're doing great. You're paying somebody to take care of them. You're paying for water, all this stuff year after year after year, and you're still not getting any fruit. So there's nothing to sell. At what point do you say, well, maybe this orchard's not what I thought it was going to be, right?
Yeah.
I think that's part of it, is what's our turnaround time to become profitable or to make money off of where all the investing is going for these companies. Now, I would think that people who are running businesses have a plan here and have an idea of how much they think they're going to need to invest before they start to see money back, and how long it would take to become profitable after what's put in up front. That's kind of what running a business means. However, from the outside, we may be less patient.
Yeah, well, when you look at the speculators of Wall Street, they generally don't have a timeline as long as you're successful investors. That it's not timing the market, it's time in the market. Cliche saying, I know, but cliches are cliches for a reason.
Right.
And when you have that speculative, short-term side of Wall Street, they're patience is not really in their vocabulary that I would say. But again, even if that is a concern, where if you say, geez, and I had a client reach out recently, he was like, I'm reading these articles, I'm seeing these headlines that the market growth has been just strictly driven by just a few different companies.
Yeah.
And interesting statistic. I need to find this, but it was I'll find it and I'll bring it up. But anyways, what it came down to is that this isn't uncharted territory, where if you look at a period of time where market growth, especially from an index perspective, that index growth was driven by an incredibly small percentage of companies.
Right.
Like, this is not uncharted territory. So what this means, what your takeaway from that should be, at least in my opinion, is that is why you diversify. Because you do not know. This kind of takes you away from this individual stock picking thought process.
For sure.
Not saying that that's a bad idea. I've seen people that have done really well from that. But again, when you're when you look at statistically, especially the S&P 500, when you have 500 companies, and I think it was about 4% of those companies, like over time, have driven like that significant growth of overall index. So you have 500 and only 4%, like over the long run, is actually going to turn out to be a winner. It's going to be really hard for you to choose that 4%. I mean, unless you are in this, you're dialed in, and even then those odds are kind of working against you. So how you can protect yourself, it is that diversification. And then we go back to having your investments serve you.
Mm-hmm.
So now we talk about timeline of money, back to the better buckets. What level of money needs to be subject to that certain level of risk? And again, whether the market is overvalued and we see a significant pullback where maybe we do see 2 years worth of gains wiped out, and you could argue that that cyclical type of correction is almost needed because and a lot of times when you have a new technology, that mania comes along with it. And then when mania starts to enter into investors, they're kind of just they love it. There's writing money to these companies that may not have that justification to receive that money, and things get overhyped. And you hit that maximum amount, and then that correction starts to come in, and it's like that old Warren Buffett saying where the tide goes out, you see who's wearing trunks and who wasn't.
Right.
And you need these cycles to wash out those bad investments or those companies that were hyped and had no justification for being valued in the first place. That gets wiped out, but there's still people still standing there. There's still people with full one-piece bathing suits on and plenty of sunscreen. And you need that to happen to show that, okay, yeah, let's remove the mania, but there are a lot of companies and a lot of industries, a lot of sectors that still benefited from that, and they were good investments. And that's why, generally speaking, when you talk about passive index investing, that works for a majority of investors over time to build wealth and accumulate wealth because those companies are the constituents of that index. So you don't have to worry about this individual stock.
Which one do you pick? Let them all, take them all.
Yeah, because within the S&P 500, or any index for that matter that you look at, you're going to have companies that really were think of like any sports team, especially, basketball, when the Golden State Warriors were at the height of their ascent. They had Steph Curry, they had Klay Thompson, they had Kevin Durant. I mean, these are probably Hall of Fame, all-star players. When you look at the percentage of points that they scored compared to the other team or the productivity that they had compared to the rest of their team, it was going to be night and day. So again, that's not a bad thing, right? But
yet they still needed the whole team to play.
Correct. And so ultimately, if this is a concern about the overvaluation of the market or a few companies that are driving the growth, what your solution to that is diversification, number one, understanding your timeline of when you need to use the money. So make sure you have that proper balance of risk. So if you do have dollars that are allocated in that third bucket, your growth bucket of money, you know that you have time on your side. So if we do see a correction,
it's okay.
Or when we see a correction, you're fine. You're okay. And you have plenty of liquidity, and maybe you can actually take advantage of that because you have some dry powder on the sideline. You can effectively dollar cost average in. You could, but if not, so let's imagine you're in retirement and you pinpointed things in a way where your liquid bucket of money, your protected bucket of money, it's like, well, I have my 3 years worth of vacations built in, and I have my 3 years worth of living expenses. So no, I want to use that money for my quality of life enjoyment. That's great. But that is how your money serves you. So then you don't have to be as emotionally tied into these headlines that are coming in saying, hey, we've never seen, or the last time we've seen this specific data set was back in the Great Financial Crisis. And you're like, oh no, Great Financial Crisis. And those numbers line up.
That's not a good phrase.
That's not good, right? Your money's not serving you in the way that it should.
Yeah.
Peace of mind, security. There's a lot of feel-good definitions that we should insert into that column. It should not be fear. It should not be uncertainty. It should not be what a lot of things that are tied around money. Let's put it that way. Jeremiah Bates, joined with Alexander Lundgren. We got to take a break. Visit therealmoneypros.com. It's where you can learn more. We'll be right back.
Hunt for top talent, the search for the right benefits package, and the ever-rising tide of healthcare rates. And putting together the right team to run your HR-related tasks can be expensive, let alone time-consuming. Enter Ataraxis PEO, your professional employer organization ready to tackle all your HR needs from payroll to benefits administration, payroll services, workers' compensation, and talent recruiting. They've got you covered. With Ataraxis, you gain access to a team of experts who handle the nitty-gritty of HR, freeing you up to focus on what you do best, growing your business and growing your revenue. Ataraxis takes the time to learn about your business, crafting personalized solutions to help you and your team succeed. So say goodbye to the stress of HR administration and hello to Ataraxis. Experience the power of a true business partner with Ataraxis PEO. Visit ataraxispeo.com. That's ATARAXISPEO.com. Ataraxis, elevating businesses for the benefit of all.
Have you ever met with a financial advisor looking for some advice just to leave being sold an annuity you didn't want? At Tree City Advisors of Apollon, we do things a bit differently. We focus on your financial goals, helping you fix past mistakes, simplify your current finances, and plan for the future with confidence. Your first consultation is always free and without obligation. Visit TreeCityAdvisors.com and start your journey to financial freedom now. That's TreeCityAdvisors.com.
As a financial advisor, I often see that many families I meet with end up paying way too much money in taxes. If a healthy family has an insurance plan with a low deductible but high annual premium, why wouldn't they look at a high deductible insurance plan instead? They could save on their premiums and put those saved dollars into a health savings account, also known as an HSA. It's the most powerful tax advantage account title available to us, so why not use it? Take advantage of pre-tax money that could be grown tax-free and then use tax-free for all of your qualified healthcare expenses. That's why you need Lively. Our favorite because it's simple, fast, and free. I use it, my colleagues use it, and I recommend it to all of my clients. Visit Lively right away. You can even roll over your existing HSA money into this new plan and start saving right away. I know you're going to love the entire experience. Visit livelyme.com/pro today. That's livelyme.com/PRO. Lively is a proud sponsor of the Real Money Pros.
We're back to the Real Money Pros.
Welcome back to the Real Money Pros. Again, last segment, we got a little bit of time to take your phone calls. Phone lines are open, 979-59-MONEY. That is 979-596-6639. Volatility is a part of the game. So how do you protect yourself from volatility? Well, it's just... You got to determine.
In the right spot.
You got to have your money in the right spot. I know that's a simplistic way, and there's so much more to that. But that's where bucketizing your money becomes so important, where you can make sure that you are getting the growth that you need. When you see a bull market, when you see the last 2 years, the S&P 500 performing over 20%, you have this year, 2025, where it looks like S&P 500 is on track to finish over 17%. Making sure that you are capturing that. You're a beneficiary of that reward, knowing that there is some risk. Well, what's the risk? Where we could see that completely flipped around. There could be some geopolitical conflicts. There could be some trade angst. There could be some, whatever the case is, that could cause the market to pull back significantly. You have to know that that's also a part of that risk-reward scenario. Right. So how do you mitigate that? It's time. Time is how you mitigate that. You look at any period of time within the market, if you give a substantial time, a decade or more, you finish higher.
Right. But you have to only put the money that has the time.
Indeed. Indeed.
If it doesn't have the time, don't put it there.
And then you have that peace of mind bucket where you have your sleep easy, where if the market is down, you're seeing investments go down, you have that other side, that liquid peace of mind, sleep easy, stable allocation of money that is not going to fluctuate. Yeah, you might get a little bit of interest on it, but at the end of the day, the dollar needs to be worth $1 the day you need that dollar. And I'm an advocate of you spending your money. And that's the beauty of that, is where if you have that money at arm's length, there's not that gut feeling of, I'm selling something in a down market that has to make, that's completely removed. So you know in your mind, psychologically, and it's mathematically solved for, I'm good. I know all these headlines, based on what the market is doing, is saying otherwise, but I'm good. I can cover my expenses for these next 3 years. I can take my family to Hawaii. I can do these vacations. I can do my charitable gifting. I can cover all that because I did the proper protocol of planning, strategizing. So yes, I do know that if I want that long-term reward, there is this volatility that I know I'm going to be subject to at some point. It's a part of the game. It's a part of it. There's nothing you can do about that. But what you can do, focus on what is in your control and defining that timeline and making sure that timeline is defined by a strategy, meaning you have insight into what your cash flow is, what your sources of income are, what is your tax liability, tax obligations, especially when you make bigger moves. Let's imagine you have some highly appreciated properties. You've been running rental properties for years and years and years, and now you're getting to the point where you want to simplify and you want to sell it. What is the implication of that? How does this affect the overall ecosystem? Ran into that scenario earlier where I have an 84-year-old client. She's been on this trajectory for decades. She's lived in her primary house. She did a great job investing. She has Social Security, a small pension. She's got a duplex rental property that she's had for multiple years. She's loved the property. It's been a great passive income flow source for her. She's single, no kids, really no immediate family members there to kind of, and I love it because she's kind of forward thinking. It's like, I need to be. And she's in great mental shape. She's in great physical shape too. I mean, she goes to the gym, I think 5 days a week. It's great. I met with her. I met her this week and she's like, I just finished working out. She's like covered in sweat. I was like, you need some water? She's like, yes, please. I was like an hour at the gym. It was fantastic. But she's arriving at this point where I need to be cognizant of my age. I need to set this next plan. So now she's going to make this transition into a senior living community. So I went down with her, visited the community. We make sure that she had someone in her corner that was understanding the numbers behind it. Great. Let's come back to the office. Let's take a look at everything, what the timeline of selling your property is, how we're going to have the financial, liquidity to cover these down payments and the monthly obligation that's there.
For sure.
And then obviously looking at the rental property. What does this look like? Turns out in the facility that she's going into, there's what's a term of prepaid medical expense that down maybe in a year or two, she's going to have a high tax benefit in her back pocket that could be used to offset the gains of that rental property. And then she's like, well, what about that passive income that I'm getting? I'm like, well, we're going to be so tax efficient on this that if we and then reinvest this money in an income base, we can beat the amount of just conservative estimate will likely beat or match what you're receiving on that rental property. And you're still going to have a tremendous amount of liquidity because she still likes to go on trips. She wants to continue to do go take cruises up to Alaska and then do her train trips, right? So that's how we're talking about this whole thing working together. And that's, again, how the buckets come into play. What's your income? Where do you need protection? And where do you need growth? Again, 979-59-MONEY. That is 979-596-6639. Let's move into quick end of year topics. RMDs, required minimum distributions.
If you haven't taken it yet, better take it. If you inherited an IRA after 2019, good chance you need to take a required minimum. There are a couple of exceptions, but pretty good chance you got to take it.
So with inherited IRAs, so Secure Act 1.0 essentially changed the route, if you will, of how you are to receive an IRA as a non-spouse. So let's just use a scenario that I think most of us are seeing, probably between you and I, with clients that we meet with you have a parent passes away, you then inherit that IRA. If the owner of that IRA passed away after January 1, 2020, you are now subject to this 10-year rule.
Correct.
Meaning, just looking at that on its own, you have 10 years starting the year after the owner of that IRA passed away that you have to liquidate that entire IRA. Meaning it just has to be distributed.
They want to collect the taxes.
Which, again, if you pull money out of a traditional IRA, it's going to be taxable to you as ordinary income. Now, where the RMDs come into play is, correct me if I'm wrong, Alex, but if the account owner, the IRA owner who passed away, if they were of RMD age,
correct,
then even if you said, well, I'm not going to take all this money out until year 10, that's fine. You're still adhering to that 10-year rule. But if they were of RMD age, you need to make sure that you're satisfying that RMD every year until you liquidate that thing.
Because you have to take it at least as quickly as they had been. If they were not in RMD status, you can wait and take it all at the end if you want. Or you can take some as you go or take it all out in the first year. Doesn't matter.
Yep. Roth, if it inherited Roth, not the case. You're still beholden to the 10-year rule, by the way. Meaning after that 10-year, you have to pull out the money of that Roth IRA, not taxable to you, but you're not subject to those RMDs along the way. Now, if you are of RMD age, so let's imagine that in 2025, you turned 73. You can take your RMD this year. You could delay it until next year. You have to take it by April 1st. But again, just don't sleep on those.
No,
The RMDs,
the penalties
you don't want to run. You don't want to run into the penalties. Just make sure that's satisfied. You got plenty of time to calculate it, remove it out of there. I would argue that if you don't need your RMD, and you've likely already satisfied it. I mean, a lot of clients that I work with, just through sustaining their cash flow, lifestyle, their goals, and taking trips and all that, we're effectively satisfying their RMD just through the distributions that we've done throughout the year. But if you haven't taken it yet and you're saying, well, I don't need it, and maybe you have a charity, a legitimate 501c that you want to contribute to, you can do a qualified charitable distribution, send the money directly from the IRA to that charity, doesn't hit to you as taxable income. One strategy that you can look at, because I've ran into some situation, talked about this last week, where a few clients were running into penalties and interest because they weren't paying enough taxes throughout the year.
Yep.
So if you have not taken your RMD yet, and let's imagine you were supposed to be paying money to the Federal Reserve throughout the year to avoid penalties and interest, you can elect higher withholding on that RMD. I have some clients where we're doing 99% of their RMD. We're just electing to go to
and
Fed.
It's better than a quarterly estimated payment because of how the IRS attributes it as being there all year long.
Exactly. They act as if that was done throughout the year, right? So, and again, that's something that you need to pay attention to, some tax efficiency. So don't sleep on your required minimum distributions. If you're self-employed, you still have some times to do. You still have time to do contributions or set up these pre-tax accounts that can be to your benefit. Some of them, not the simple IRA, solo 401k, you could certainly look at. And if you have an HSA or a flexible spending account or a medical savings account, look at those medical costs that you've paid out of pocket throughout the year, and you might be able to reimburse yourself from these qualified accounts to be efficient. Again, this is The Real Money Pros. We are on a 7-day break, and we'll see you next time. Alex, thank you so much for joining us. Everyone take care.
The Real Money Pros is hosted by Brian Wiley and other team members of Tree City Advisors.